Hello and welcome back to Explain the Charts. Today is November 25th, 2025, and we are diving deep into the Nasdaq 100 ETF, QQQ. We've just seen a massive surge to kick off this holiday-shortened week, and there's a lot to unpack. First, we'll cover the huge news catalysts driving this move, and then we'll jump into the charts to see what the price action is telling us about what could be next. The market exploded yesterday, with the Nasdaq leading the charge, rallying over 2.5% in the underlying index. This powerful move was driven by two major themes. First, we have a massive revival in the AI trade. Elon Musk's tweets about Tesla's advanced AI chip development sent Tesla stock soaring, adding billions to its market cap. At the same time, Alphabet saw a huge jump as its Gemini 3 AI model received high praise, reinforcing the narrative that the AI revolution is just getting started. The second major driver is the growing optimism for a December interest rate cut from the Federal Reserve. Dovish comments from several Fed officials have pushed the probability of a cut to over 80%, according to the CME FedWatch tool. This combination of AI hype and hopes for cheaper money is extremely bullish for growth-oriented tech stocks. However, keep in mind we have a batch of delayed economic data, including retail sales and PPI, due out this morning, which could shake things up. With the market closed for Thanksgiving on Thursday and an early close Friday, we could see some lower volume volatility later this week. Now, let's look at the daily chart for QQQ to put this all into context. As you can see, we've been in a strong uptrend for most of the year, rallying from the lows near 422 back in April. The market pushed to a new all-time high right around 635 in late October before hitting a wall. Let's zoom in on the more recent price action. After hitting that 635 high, QQQ experienced a sharp pullback of over 8%. This culminated in a massive, high-volume bearish reversal candle on November 20th, where the price dropped over 4% in a single session. That day's action was brutal and wiped out several weeks of gains, establishing a critical short-term support level right around 585. This perfectly matches the news reports of a stunning reversal that spooked the market last week. Now, switching to the hourly chart, we can see this reversal and subsequent bounce in more detail. Here is the dramatic sell-off on the 20th. Price then stabilized on Friday the 21st, forming a base just above that 585 low. Then, yesterday, on the 24th, we see this huge gap up at the open, fueled by the positive weekend news. The market opened around 595 and never looked back. This gap, from Friday's close around 590 to Monday's open near 595, has now become a key area of potential support. Looking at yesterday's action on the 15-minute chart confirms the strength of the rally. We gapped up and saw consistent buying pressure throughout the entire session. There were very few pullbacks, and the market closed right near the high of the day around 605. This indicates strong institutional buying and conviction behind the move. So, what is the bullish case from here? Bulls will point to the powerful defense of the 585 support level and the strong follow-through on incredible news. The narrative has clearly shifted back to risk-on. If QQQ can hold above the 600 level and break through minor resistance around 610, the path is clear for a retest of the next major resistance zone around 625. Ultimately, bulls are looking for a return to the all-time high near 635. This scenario becomes much more likely if today's economic data comes in soft, further cementing the case for a Fed rate cut. On the other hand, what is the bearish case? Bears will argue that this is just a relief rally in a new downtrend. The sell-off from 635 was fast and aggressive, and one strong day doesn't erase that damage. If the market fails to find follow-through buying above 610, it could be a sign of weakness. The first red flag for bears would be a move back down into the 590 to 595 gap. A close below that gap would be concerning, but a decisive break of the critical 585 support level would signal that the correction has much further to go, with the next major support area not appearing until the 560 to 570 range. A surprisingly hot inflation or jobs report today could be the catalyst for this bearish scenario. To recap, let's lay out the most important levels and potential outcomes. Your key resistance levels to watch are 610, followed by 625, and then the all-time high at 635. On the downside, your key support levels are the gap between 590 and 595, and most importantly, the recent low at 585. Given the powerful momentum and strong news catalysts, I believe there's about a 65% probability that we test the 620 to 625 resistance area in the near future, possibly even this week if the economic data cooperates. The strength in megacap AI names is a very powerful tailwind. I'd assign a 25% chance to a period of choppy consolidation, perhaps between 595 and 610, as the market digests these big moves in a low-volume holiday week. Finally, I see only about a 10% chance of an immediate bearish reversal that breaks the 585 support level, though this probability would increase significantly if we get unexpectedly hawkish economic news or Fed commentary. So, the main thing to watch today will be the market's reaction to the morning's economic data. That will set the tone for this short but pivotal week. Thank you for joining me on Explain the Charts. If you found this analysis helpful, please hit the like button and subscribe for more. Remember, this is not financial advice and is for educational purposes only. Always do your own research and make investment decisions that are right for you.